What does it mean to be a millionaire? There are a few ways to think about it. The first is what most people probably think about when they think of a millionaire: someone with over $1 million in cash. And yes, it would be great to have $1 million. Who would not want to have $1 million to spend on whatever they want? But realistically, few people keep this much money in cash. Most millionaires keep the bulk of their money in investments, stocks, bonds, or real estate that allows them to earn a passive income. Because they earn a passive income, millionaires are free to quit their jobs, start new businesses, and take risks most people could not afford to take. Another way to think about being a millionaire is by thinking about net worth. Net worth means the total value of everything you own. It includes your car, your house if you're a homeowner, and other assets like valuable collectibles. It also includes debt. If you don't own a house, have no savings, and owe $50,000 in student loans, you may even have a negative net worth. Here's the thing, no matter how you define being a millionaire, it's not really about the money. It's about having the peace of mind of knowing that you have a massive nest egg saved up. It's about the freedom to take risks, or work for a nonprofit, or just take it easy. And for the average person, it's about having the patience to build up $1 million investment over time. Let's say you're a typical college graduate with a bachelor's degree. You work for 40 years, earning an average of $50,000 over your career. In that time, you'd earn exactly $2 million. Once Uncle Sam took his share, you'd be left with $1.5 million. Think about that. You could work your entire life, and after taxes, you'd have a total of $1.5 million. That's what you have to buy a house with, to buy or lease cars, to buy your groceries, to pay your bills. That's it, for 40 years. And after paying all of life's expenses, you'll still need to have $1 million if you want to retire. Let's say you wanted to save that money. You'd have to save 2/3 of your after-tax income, leaving you with $500,000 to live on for 40 years. That's $12,500 per year. Technically doable, but you'll be living at the poverty line. And with $50,000 a year in income, you won't qualify for food stamps or the other types of help that actual poor people can get. So unless you want to be absolutely miserable for 40 years, you'll either need to earn a lot more, or you'll never be able to save $1 million. This brings us to the real point of the video. For the average person, $1 million is half a lifetime's earnings. You won't be able to accumulate that kind of wealth just by saving. Instead, you'll need to invest your money, so it grows over time. Let's use a simple example. You invest $100 in a stock or a fund that earns an average rate of 10%. Then you wait 40 years and sell your investment. At that rate of growth, that original $100 will have grown to over $4,500. A $1,000 investment over the same time period would grow to an absurd $45,000. Thanks to the multiplying power of investing, even a small amount of original seed money can be worth a lot more later on. So, how much do you need to invest to become a millionaire? Obviously, it depends on how fast you want to get there, but we'll stick with the example of 40 years, since it's a good estimate of the average person's career. It's also the number used by personal finance guru Dave Ramsey. Ramsey says that anyone can retire a millionaire if they invest only $100 a month in a fund that earns an average of 12%. If you use the SEC's official compound interest calculator at investor.gov, Ramsey's math checks out. In fact, if you follow his advice, you'd end up with a whopping $1,216,288.46. Not bad. Here's the thing. There are very, very few investments that earn that kind of return on a consistent basis. By way of comparison, the stock market as a whole grows at a rate of around 8% on average. So you're looking for an investment that consistently returns 50% better than the market average. In fact, this kind of performance is so rare that we were only about to find 2 investments that meet Ramsey's criteria. The first of these is the American Funds Investment Company of America, AIVSX. That fund has been around since 1934, and over that time, it's returned an average of exactly 12% per year. The Pioneer Fund, PIODX, also comes very close. Since its inception in 1928, it's earned an average of 11.88% per year. So Dave Ramsey was right. You can technically become a millionaire by investing only $100 per month. Technically. See, there's a reason investment advisors and advertisers always have to say past performance does not guarantee future results. It really doesn't. Anything could happen. For example, you could have a healthy economy and a massive global pandemic could appear out of the blue and ruin everyone's plans for the next 2 years. That's something no analyst could have predicted. Not only that, but 40 years is a long time. 40 years ago, Ronald Reagan was president, the Soviet Union was still a country, and the internet was an obscure computer network used by the military and a handful of universities. Who knows what the world is going to look like 40 years from now? Assuming that any fund can earn 12% for that long is a fool's gamble. I'm not trying to be a downer here. I'm just saying that if you want to save $1 million, you should be investing more than $100 a month and maybe diversifying into more than just one fund. By taking a more conservative approach to the market, you're less likely to get burned when there's inevitably a downturn. With that in mind, let's assume that instead of earning 12% on your investment, you earn the market average of 8%. If you invested $100 a month, after 40 years you'd have a little over $350,000. That's not bad, but it's not enough to retire on. So what would you need to invest every month to earn $1 million at 8%? Using the SEC's calculator, you'll find that you'd actually need to invest $282 per month to accumulate $1 million after 40 years. That might sound like a lot, but think of it this way: you pay more than that for rent, and very likely for the utilities. Isn't an investment in your future worth $300 per month? Let's look at it another way. Remember our early example of someone saving $1 million? They'd have to be socking away $25,000 per year, or over $2,000 per month. $282 per month is nothing compared to that insane rate of savings. Of course, there is a way to earn $1 million and retire even faster: real estate. By investing in old properties, fixing them, and selling them, you can easily double your money. And by purchasing newer properties and renting them out, you can earn a consistent passive income to pay your bills or to reinvest in new properties. The downside of real estate investment is that if you want to get serious about it, it can easily turn into a full-time job. Yeah, being a landlord means you get to collect rent, but it also means that when somebody's hot water heater explodes at 2 in the morning, you're the one getting the phone call. The only way to make this a truly passive income is to own enough properties that you can pay for a property manager. And if you can afford that, congratulations, you're already a millionaire, and you don't need my advice. So for most people, stocks and bonds are going to be the best type of investment. But which stocks should you invest in? The short answer is that nobody knows. In any given year, any given company might do well or poorly. Imagine you had invested $1,000 in Amazon just before the pandemic. Over the course of 2020, you would have reaped a rich 75% reward. On the other hand, if you'd invested the same amount of money in airline stocks, you'd have spent the whole year biting your nails. One solution is to invest in a fund. Remember those 12% growth investments we looked at? Both of them are funds. A fund is simply a collection of stocks. So when you invest in a fund, you're investing in multiple stocks at the same time. The result is that the risk is spread out. Theoretically, if 1 or 2 companies in the fund perform poorly, other companies will compensate for the losses. There are a number of funds available, including index funds like the S&P 500. These funds draw from an entire stock index, such as the S&P 500 or the Dow Jones Industrial Average. Because those indexes are made up of the most prestigious companies, they're generally considered the most reliable. I am not a licensed financial advisor, so please do your own research before spending your own money. Another popular strategy is called dividend growth investing, or DVI. With DVI, you invest in blue-chip stocks that pay dividends. These are generally the most reliable companies, and they can afford to pay these kinds of dividends, which you can either spend or reinvest in new stocks. On the downside, DVI stocks don't tend to grow as quickly as other stocks, since they're older brands. Regardless, you'll need access to the market in order to start investing. In the old days, this meant going to a stockbroker, a financial professional who could buy and sell stocks on your behalf. It also meant paying a broker's transaction fees, which can add up over time. If you'd rather not pay transaction fees, a smartphone app like M1 Finance or Webull is a great way to get started. These apps allow you to invest directly from your phone without having to go through a stockbroker. You can find links to M1 Finance and Webull in the description for this video. Both are affiliate links that help the channel when you use them to sign up. Make sure to leave a like and click the subscribe button and the notification bell if you haven't already. Happy investing!